Hey everyone, welcome back to Corporate Decoder, the place where we break down the opaque language of corporate finance and give you the real story behind the numbers. So buckle up, because today we're diving into Credit Suisse Asset Management Income Fund's latest semi-annual report for June 2025. And let's just say there's some interesting performance data to decode. And if you appreciate getting straight, unbiased insights from these filings, then smash that subscribe button and join our Discord community linked in the description below to keep the conversation going. So what's the headline for Credit Suisse Asset Management Income Fund for the first half of 2025? Well, overall, the fund posted a total return of 3.70% based on its net asset value, or NAV as they call it. Think of NAV as the fund's inherent worth if you were to sell all its assets and pay off all its debts. But here's where it gets more interesting when we look at the return based on market value, which is how the fund's shares actually traded on the stock market. The return was a much higher 7.67%. This difference between MF and market return tells us something about investor sentiment. The market was willing to pay more for the fund's shares than its underlying assets were technically worth on paper. Now, how did this performance stack up against its benchmark, the ICE BOFA US High Yield Constrained Index, which essentially tracks the performance of lower quality corporate bonds? That index returned 4.55%. So in the first half of 2025, the fund's market price performance actually beat its benchmark, while its NAV performance lagged slightly behind the benchmark. Zooming into the details of what drove these returns, the report highlights that BB-rated bonds, specifically those rated by S&P and Moody's as BB, outperformed the benchmark index. These are considered more speculative, but still have a decent chance of paying back their debts. For instance, we see holdings like AR Escrow Issuer LLC company guaranteed notes rated BB-2 showing up in their aerospace and defense portfolio. These kinds of holdings can be great for income, but carry more risk than safer investments. On the flip side, CCC-rated bonds, which are at the lower end of the credit quality spectrum, the riskiest and therefore offering the highest potential yield, underperformed the index. This suggests that while investors were willing to pay a premium for the fund's market value, they were more cautious about the riskiest parts of its investments. Looking at the industries that did well for the fund, food and drug retailers, non-electric utilities, and pharmaceuticals were the winners. These sectors generally provide stable demand for products and services, making them more resilient. However, not all sectors were so fortunate. Media, diversified rail and department stores were the laggards with negative returns. Department stores especially have been facing tough times with online competition and changing consumer habits. A positive note for the high yield market overall is that default activity remains pretty low, which is great news for bondholders, as it means fewer companies are going bankrupt and failing to repay their debts. The report states the default rate ended the period at a solid 1.41%, continuing a trend of lower defaults. Interestingly, the fund saw positive inflows from investors, which means more money came into the fund than went out, continuing a trend from the previous year. This suggests that despite some market jitters like those around trade negotiations that temporarily caused outflows in April, investors were still finding value in high yield assets. So to recap, the funds never didn't quite keep pace with its benchmark in this 6-month period, but its stock price performance did better. This shows that while the fund's underlying investments didn't grow as fast as the benchmark, its market appeal or investor demand outshone that. Looking ahead, the investment advisor acknowledges that costs to borrow money are still pretty high, and global issues like political tensions could hurt consumers and businesses. They're staying disciplined with their investment standards because of these risks. Now, let's dive into the fund's investment breakdown. As of June 30, 2025, a significant portion of the fund's investments were in bonds rated BB, and 2% were rated B. These are the core of a high yield fund, meaning they carry higher risk, but also offer higher potential income. Only a small fraction, 2.5%, was invested in BB rated bonds, which are considered investment grade, though on the lower end of that scale. And then there's the riskier end with 12.4% in CCC rated bonds. These are the bonds that are more likely to face difficulties, especially in an economic downturn. The bulk of the fund's investments are in corporate bonds, making up over 107% of its total investments. That's a little unusual, but often means they're using leverage. In the aerospace and defense sector, for example, they hold notes from companies like Amentum Holdings Inc. with a 7.25% interest rate maturing in 2032. They also have exposure to Bombardier Inc. with a 7.55% interest rate on unsecured notes. Due in 2029, Bombardier, as many know, has had its share of financial ups and downs. A very notable holding is in Altice France SI in the cable and satellite TV sector. What's striking here is the rating D, which means this bond is in default. They also have notes with a 0% interest rate on these defaulted bonds. This is a classic example of high yield investing where you might see defaults, but the potential for higher returns on other holdings can offset those losses. Beyond corporate bonds, the fund also has a significant portion, 21.6%, in bank loans. These are typically floating rate loans made by banks to companies that often have lower credit ratings. For example, they have a bank loan investment in MH Sub I LLC with a stated rate of 8.577%. And in the automotive sector, there's Fastlane Parent Co. Inc., rated CCC, with a 0% interest rate. This again highlights the risk in the portfolio where some investments are struggling. The fund also holds 6.3% in asset-backed securities, specifically collateralized debt obligations or CDOs. These are complex financial products backed by pools of other debt assets. An example is Anchorage Capital Sukalo 25 Limited. Rated bar 3, a decent rating for this type of investment, offering a yield of over 11%. Now let's look at the fund's overall financial health on its statement of assets and liabilities. The fund has a loan payable of $63 million. This is a leveraging tool used to potentially boost returns, but also adds risk, especially if interest rates rise or the fund's investments don't perform well. And the net assets, the total value of the fund after accounting for all liabilities, stands at about $61 million. This translates to a net asset value per share of $2.94. Interestingly, the market price per share was slightly higher at $2.96. This again signals that investors were paying a small premium for the fund's shares. The statement of operations shows how the fund made and spent money for the 6 months ending June 2025. They paid $391.44 in investment advisory fees, which is expected, as that's how the fund managers get paid for their expertise. A significant expense is interest expense, totaling almost $1.6 million. This is directly tied to that $63 million loan they have. It's a cost of using leverage. Despite expenses, the fund generated net investment income of over $6.3 million. This is the core income from the fund's investments before considering market gains or losses. However, they also reported a net realized loss from investments of about $686, about $82,000. This means some of the bonds or other assets they sold were sold for less than they bought them for. On the flip side, they had a net unrealized appreciation from investments of nearly $900,000. This means the value of investments they still hold went up overall, even though some were sold at a loss. All in all, the fund saw a net increase in its net assets from operations of about $6.2 million. That's a positive sign for the fund's overall performance. Looking at the changes in net assets for the period, we see the movement of money in and out of the fund. The fund paid out over $73 million in distributions to shareholders. This is how the fund returns income to its investors. Interestingly, the fund had a net decrease in net assets from capital share transactions of about $596,000. This is likely due to offering costs and other share adjustments. And as we saw earlier, the net assets ended the period at roughly $161 million. Finally, the financial highlights give us a snapshot of key metrics over time. The total investment return based on NAV for the 6 months was 3.70%, which we already discussed. And the market value return was 7.67%, showing that strong market performance we noted earlier. The ratio of net expenses to average net assets is 302%. This is a bit on the higher side, especially for a high yield fund, and it reflects the costs of managing these complex assets and potentially leveraging the portfolio. However, the ratio of net investment income to average net assets is a healthy 8.03%, indicating that the fund's core investments are generating good income relative to its size. The portfolio turnover rate was 24%. This is relatively low, which can suggest a more buy and hold strategy rather than active trading, perhaps focusing on longer term income generation. So what's my take on Credit Suisse Asset Management Income Fund's latest report? Well, on the surface, the fund delivered a decent market return, beating its benchmark in terms of share price performance. However, dig a little deeper and you see a portfolio heavily weighted towards riskier BB and B-rated bonds, with some holdings even in default like the Altus France SA notes. This strategy aims for higher income, but it's not without significant risk. The difference between EV and market returns suggests investor demand is current income, but it's not without significant risk. The difference between EV and market returns suggests investor demand is currently a strong driver for the fund's share price. The higher expense ratio is a point to watch, especially for investors focused on cost efficiency. They are using leverage which can amplify both gains and losses, and the interest expense on that loan is a substantial cost that needs to be continuously covered by investment income. The low default rate overall is a positive external factor, but the fund's own exposure to defaulted and zero yield debt warrants careful consideration. In essence, alright, that's our breakdown of Credit Suisse Asset Management Income Fund's June 2025 report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives, and don't forget to check out our Discord in the description. Thanks for watching. See you next time.